Hello, everyone, and thanks so much for joining us for today's webinar. My name is Steve. I'm part of the customer success team here at Snap, and I'm joined today by Anu and Lee as well. They'll be in the question section of our webinar, answering your questions live or surfacing them up during the session so that we can talk about them in more detail and present within the software as needed. Today's session is approved for one FP Canada CE credit, so that's great news, and anyone that either qualifies as an FP Canada certificate or an MFDA licensed representative will be able to, at the end of our session today, respond to a quick 3-question survey, just looking for your name and email address, and we'll be able to send you out a certificate for one approved CE credit. I'll discuss a bit more detail about that very shortly. Just to make sure that you're able to hear me and see my screen okay, if anyone can access the GoToWebinar portal and then click on the question in order to submit your questions, just let me know if you can hear me okay and see the screen. This is also where you'll be able to submit any questions during the session today so that Lee and Anu can either answer you directly, surface them during the session, or we'll get back to you by email within the next week if we can't answer you live. Thanks very much, Braden, Kimberly, Thomas. So it looks like everything's working great. Awesome. So once again, a bit more detail about the CE credits available for today. 2 hours after this session finishes, attendees who stayed for the full session will receive an email with the video recording and a request to respond with your full name for your CE certificate. So it's just a quick 3-question response that you need to give us so that we can customize the certificate, and then we'll send you that by email. And it does take us a bit of time to process that manually, so we'll have those to you by October 31st at the latest. Once again, it's eligible for 1 credit in the category of financial planning for FP Canada certificates and or 1 credit for professional development for MFDA licensed representatives. This is only available for live attendees, so if you're watching the recording of this, we do apologize. We will be offering these in the future as well, and we're hoping to continue to be approved for CE credits. So if you're able to join the next one live, we'll be happy to offer those certificates, and anyone that's here right now will be able to qualify. Today's agenda and session is really all about getting you guys up to speed with all of the recent changes that we've made in the software. So over the last 3 or 4 months, we've made quite a few enhancements that might have you a little bit disoriented in the software. So we want to make sure that you're comfortable with where everything is available and that you're able to take advantage of what those new capabilities are providing within the software. So we're going to demonstrate some new features such as the income enhancements that we made, the additional expenses that you can now add, and the updates to charts. We'll be reviewing the planning pages. This is where we've added some new columns, we've grouped some columns together, and then we've reordered them to make a bit more logical sense in terms of how they're related to one another. We'll also summarize some of the previously released features and the support resources that are available for those. So whether those are articles or previous webinars that we've done on them, we just want to make sure that you're aware of all the changes and where you can get more information as needed. And then we'll talk a bit about best practices and tips for creating quick and efficient plans. So these are just things that common questions that come through to our customer success team, or tips and tricks that are going to save you time or give you more confidence in the software. We'll leave some time at the end for questions, so feel free to submit those throughout the session. If we're not able to get back to them right away, we will get back to you by email over the next week. And with that, let's jump into the software and create a projection for our clients today. So I'm going to click Add New Client. We're going to be creating a projection for Rianne Campbell, born 1967, currently living in British Columbia, and his spouse, Olivia Campbell, born 1969, 0101. Now that we've added our client detail, we'll see in the software that there are 3 main sections. There's the scenario setup, which is the input pages on the left here, things like expenses, incomes, assets. Once we're done entering in our base plan data, then we will go to the planning pages where all of that information comes together to show our client's life on one page. Once we're done adjusting any of the year-to-year values or for any periods of the projection, We can then go to the client report in order to customize the charts and tables that are included and add any commentary that we'd like for a final client-facing document. For the time being, we're just going to proceed through the scenario setup and enter all of the data that we've collected for Rianne and Olivia. I'll click Next at the bottom and go to the General Settings page. The first input option that we have is the start year for the plan. So by default, the plan starts January 1st of the current calendar year. As we get closer to the end of the year, a lot of users of Snap will choose to start the plan as of January 1st, 2024. This is just a simplified and conservative assumption so that the input values that you're entering for things like assets and debts are not going to be impacted by this calendar year's assumptions in the software. We're just going to start the plan cleanly as of January 1st, 2024, and then project out from that point forward. You can, of course, continue to use 2023 as the current year for your projections, especially if you're modeling transactions in this specific year. You may want to continue to be able to do that within the software. For this plan, I'm going to start it as of 2024, and that's just going to create a simplified and conservative assumption as we're inputting all of their information. We're going to run the projection with a retirement age of 65 for Rianne and 63 for Olivia. So this is going to have them retiring in the same year since Olivia is 2 years younger. And then we're going to run the projection until age 100 in order to have them both passing away at age 198. As we scroll down, we can customize things like the general inflation rate in our plan. We're going to use the FP Canada guideline assumption of 2.1%. And then for rates of return, I've reduced the FP Canada guidelines to 1, 2, and 5 in order to account for expected management fees on the investments. So you can customize these, and then if you make any changes and you want to save those settings for future plans, you would just come to this defaults button, click Save Current Page Settings for new scenarios, and that's going to carry forward those new rates for all new plans. I'll click Next and go to the Expenses page. Now, expenses in Snap are one of the most important pieces to fully understand because it's such a unique set of capabilities, and we want to make sure that you're able to take full advantage of what's available. So the first thing of note is that some expenses are entered elsewhere in the software. So things like debt payments, insurance premiums, and education costs. You'll see as I click on this helper text, we get some definitions and additional information. So for debts, I will enter that once I reach the debts page of the scenario setup. If there's an insurance policy, I can enter that here and the associated premium. And then if there's an RESP, I can enter that under the education section. The reason that we separate these from an expense standpoint is because these are only going to be related to part of the projection. For instance, if it's a mortgage, it's only going to be relevant for the 10 or 20-year period while they're repaying that mortgage, and then that expense is going to stop. Same thing for RESP contributions or insurance premiums. So we want to carve those out and tackle them separately in the software for the period that they're relevant for our client's situation. There are also going to be some expenses in the software that are calculated automatically for us. So things like CPP and EI premiums and income taxes are automatically going to be calculated and deducted from the client's cash flow once we've entered in the relevant information, such as their employment income. So when you're entering your client's expenses in the software, you don't want to duplicate any of these values. So if you're entering a mortgage under the debts page, you don't want to include those mortgage payments as part of your client's base expenses because that will be double counting the cash flow need. Instead, you'll enter it just under the debts, and then the base expenses is more so meant for consistent annual lifestyle spending, things like groceries, transportation, hobbies, expenses that are expected to be fairly consistent throughout the projection. So for base expenses, you'll just do those consistent annual amounts. Then you'll enter in the separate sections throughout the scenario setup. And then we now have a new feature, which is additional expenses, which allows you to kind of itemize and categorize expenses as you see fit in order to call more attention to them throughout the plan and to help your clients make sure that they're on track for all of their goals. So with base expenses, you can enter the combined goal from this page here. This is essentially the previous after-tax spending value that you may be familiar with from the planning pages, we've now given you the option to enter it directly on the scenario setup page. But you don't have to enter it here. You'll always have the option to customize the client's base expenses from the planning page. So you can leave this as 0 if you don't know what it's going to be, or in this case, I'm going to enter 96,000, which is the client's real retirement spending goal for their base expenses. So this would be generated each year of the projection, starting at the first year of retirement, all the way to the end of the plan. And the software is automatically going to increase this amount for inflation for each year of the plan. So again, you can enter it here if you'd like, or we can wait and I'll show how to input it on the planning pages and how to customize it over time if desired. With the base expenses taken care of, I'm then going to add a few additional expenses. These are more commonly for things like lump sum expenses or for expenses that are a high priority for the client or that they might want to draw attention to in the charts. So the first one is additional travel of $15,000, and they're going to split that expense evenly between the two of them, so we'll set that as joint. For inflation, expenses default to be linked to the general inflation rate in your plan. So if you recall, on the general page, we were able to indicate what we want our general inflation rate to be, which is 2.1 in this case. So when we're adding expenses, we can have that directly linked to the inflation rate so that if we change the inflation rate at any point in the future, these expenses will be automatically indexed to that new value. We can also enter a specific percentage if we want. So if we want to assume a 1% inflation rate or a 3% for this specific expense, we can customize that by entering a value here. And then once again, if you delete all information in the cell, it'll go back to linking to the general inflation. So you don't want to type in general inflation itself. You leave the box empty and that's going to tie it to the general inflation rate. We can also enter a from age. So in this case, their additional travel goal is going to start in the first year of retirement when they're 65. And we're going to run that for a decade until they're 74. And we want that budget every year. And we're going to highlight that so that it shows up as a specific call out in the expense chart of the plan. I'll click add expense, and we're also going to do car purchase of 35,000. We'll link that as well to general inflation. Their next car purchase is expected in the first year of retirement, and then they're going to do that until they're 80. Instead of doing every year, we will change that in the dropdown to every 5 years. So every 5th year of the projection, they'll make a new purchase for $35,000 adjusted for inflation into that future year. And then we can highlight that in the chart as well. And finally, we'll add a gift to children for $150,000. This time, we're not going to link it to the inflation rate. We just want the assumption to be a clean $150,000 in that future year. And we're going to do it as of our client's age 60 and just for 1 year. So by entering the same age in the from and to, this will just create a single year's expense for this dollar amount. And we're not going to adjust it for inflation. And we are going to highlight it within our chart. So now we've been able to understand that some expenses are tracked separately in the software from debts, RESPs, insurance premiums, things like that. Some are calculated for us automatically. Anything else that we want on a consistent annual basis, we can enter in the base expense. And then for the more one-off or high priority goals, we can itemize those under additional expenses. With all of the categories, you'll see these helper texts beside each of the labels. This is just giving you a bit more information about what's intended to be included. This is a common theme all throughout the software. So if you're ever not certain about what you're supposed to be putting into a field, you can use these definitions to learn a bit more about what the intended use case is. As we scroll down, there are 2 advanced options related to your client's expenses. If you click show, you'll have the option to enable either of them. Now, it's important not to enable these unless there is a very specific use case in mind. The first checkbox is intended if your client has separate finances within their household. So normally if you put a $96,000 spending goal, Snap will split that between the spouses on a proportional basis relative to their available resources. So if one spouse has more income or more assets, they will be responsible for spending more of the $96,000 a year. If you check this box, you'll be instead able to set a specific spending goal for each client regardless of their resources available. And then the second advanced option, some clients want to assume that their spending will either increase at a faster rate than inflation or a slower rate than inflation. As a faster rate, it might be just a conservative assumption that maybe their expenses outpace the rate that their CPP and OAS is going to increase over time. As another example, if a client is getting older, they might not keep pace with inflation because their activities and spending patterns might decrease over time. So those are two more advanced use cases where we have additional functionality as required. And this is a fairly common theme throughout the Snap software. A lot of the settings are set up by default to be the more conservative and straightforward, more common settings. But we do have a lot of capabilities that if you come across a unique case and you ever have questions, you can send us an email or give us a call, and we'll likely have a way that you can model that for your client's needs.
Hi, Steve. Just before you continue on, could I jump in for a quick second?
For sure.
So we had a great question from David. Just why wouldn't you want to just add all of your household expenses under additional expenses and list multiple categories there?
Yeah, so there's a couple considerations there. One is that it can be quite a lot of information to digest once you get to the planning pages. So if you have 10 columns of different expenses, those will each show up as separate columns once we get to the planning page. So it can be a lot of information to track and be certain that you're keeping everything straight in the plan. Another reason is that, as I just mentioned with the automatic allocation, Snap has a very sophisticated algorithm that assigns spending between spouses each year. So this 96,000, maybe 46,000 goes to one spouse one year and 50 to the other. And then the next year, one client is still working, and so they get 90,000 of the spending and the other gets 6. That same algorithm has not been applied to the additional expenses. So if you enter them all here, then they're going to get split 50-50. And if your client's assets aren't roughly split 50-50, then you might run into shortfalls for one spouse, but not the other. So it is possible to itemize expenses, and you can get very granular as desired, but it's just important to be aware of the assumptions that are underlying the additional expenses to make sure that you're making the best use of it.
Thanks, Steve. And I guess one other thing is that you can highlight these items in the cash outflows chart, but we can only highlight up to 6 items between both spouses.
Yeah, and then anything beyond the 6 that you're highlighting will be just lumped together as other additional expenses. So you'll still see the expense, but they'll be grouped together with other categories. And that's just because, as we'll see in the chart shortly, there's limited numbers of colors and room for the legend to call out each expense.
Thank you.
Yeah, so that's the expense feature that was recently added to the software. I'll click next and go to the incomes page. So once again, we're going to be able to customize the amount, the start age, the end age. So in this case, Rianne is currently earning $100,000. By default, the indexing for employment income is set to 0. We can delete that value, and that's going to link it directly to the general inflation rate. Or again, we can enter any percentage that we want. I'm going to delete everything from the field, link it to the general inflation. It's set as employment, so it's going to deduct CPP and EI. It's going to be taxed, track RRSP room, and then a blank from field just means that it's going to start right from the beginning of the plan. And it's going to run until the end of the year that the client turns 64. If we want, we can click on this gear symbol and set a specific date for the employment income to end. So if your client is retiring partway through the year, we could click on the month and say 08, 01 if they're going to retire on August 1st, and Snap will prorate their employment income for that last year of work. By default, I'm just going to assume that they continue to work until the end of the year and then that they retire January 1st in the year that they turn 65. In this case, Rianne and Olivia have a rental property that they are currently own and renting out. So I'm going to enter in net rental income. They're each receiving $10,000 of net rental income. So this has already deducted off the non-debt related expenses. So things like property taxes, maintenance, insurance, that has been deducted from their monthly income. We've gotten the annualized amount, which is 20,000 total. So they're each earning 10,000 of taxable income. I'll index that to the general inflation rate, and then I'll set the taxable status to yes. We're going to assume that that income continues until the end of the year that they turn 74, because they're going to sell the property at age 75 to use the proceeds to continue to fund their retirement spending. If you ever have questions about inputting things like rental properties or rental income, you can always go to Help in the top right corner, go to Help Center, and then search for key terms such as rental. So how to enter rental properties. So we have articles, webinars, lots of great resources for how to input various transactions into the software. And if you ever can't find the answer, you can give us a call or send us an email by clicking on Contact. On the right, we can also use this Actions column to save a bit of time by copying this same income over to Olivia. So I'm going to click on the green button, and that's going to create a replica of that rental income over on Olivia's page. Rianne is also going to receive a pension. So at age 65, they're going to receive $28,000 per year with a 60% survivor benefit, 1% indexing. SNAP does have an option to enter a bridge benefit if the client is starting their pension before age 65, but this doesn't apply in this case because the client is going to retire at age 65. We also have the option to enter in the pension contributions as a negative income in the plan. So I'm going to add income, call this pension contributions, and I'll enter negative $6,500. So the client's portion of the annual contributions for the defined benefit plan is $6,500 a year. We're going to assume that that will increase with their employment income over time at the rate of the general inflation rate. And then we're going to set that as taxable income. So the negative 6,500 will offset some of their taxable employment income, and it will give us a more accurate reflection of the client's marginal tax rate in the plan. And then we're going to continue that until age 64 when the client plans to retire. So now we've set up all of the income information for Rianne. We can click on Olivia and do the same. So she's currently earning $110,000 as employment income. The default again is 0 indexing for conservative purposes. I'm going to clear that value and link it to the general inflation rate. And then we're going to have that run until age 62, which is the year before she retires. And again, if we click on the gear, we could prorate that for a specific end age if we wanted. So that's everything that we wanted to input for incomes. I'll click next and go to the assets page, and we'll start with Rianne. You can see by default, SNAP has added a non-registered account to the projection for 2 purposes. One is to show you how to add an account, how to enter in the asset allocation, and the other is to provide the software with a future surplus bucket where it can put any money that's expected in a later year of the plan if there's more money than needed. So if the client's going to sell their property or if their pension income is expected to be higher than their spending need, the software wants somewhere that it can put future cash flow. Otherwise, if we didn't have this non-registered account, the software would just show us that there's a surplus and it would track that separately in the projection. So you always want to have at least a non-registered account. If the client doesn't already have one, you can just set a $0 value and let the software have access to an account in the future if it ever needs one. In this case, they both have a non-reg TFSA and RSP, so I can delete this one and just enter in their existing account information. So there's a non-reg worth $80,000. That's invested as 40% fixed income and 60% equity, and we can update the cost base to 70,000. There's also a TFSA worth 90,000. That's invested as 30% fixed income, 70% equity. He has an RRSP worth 180,000, and they have their gift to kids of 150,000 that they've set aside that they plan to give away in a few years. So that's a joint account, and that's 100% in fixed income at the moment. So you'll see by default, all of our accounts have been pre-populated with the rate of return settings that we entered on the general page. We can customize these on an account by account basis. So for instance, if the gift to children was in a GIC earning 4%, we could update the fixed income rate assumption just for that single account. We can also see that Snap is calculating the total return assumption for the portfolio based off of the asset allocation. Across the top, we have options to customize the different registered account types. So I'll click TFSA. You'll see that Snap pre-calculates a first-year contribution room of $6,500. If the client had additional contribution room available, you could enter that in. Otherwise, it's just going to assume conservatively that they just have 1 year available in the plan. I'll go to the RRSP and I'll update this to $35,000, which is the current room that the client has available. And for additional pension adjustments, they currently have a $12,000 a year PA related to their defined benefit pension plan. I'll come back to the assets, review the accounts once more, and then we can scroll down to the real assets section in order to enter in their home and their rental property. So they have a home currently valued at $750,000 with a cost base of $400,000. We can set a custom appreciation rate as we would like. It defaults to the rate of inflation. We can set that as a joint real asset and it's non-taxable because it's their principal residence. And then we'll add a rental property worth $600,000 with a cost base of $350,000. We'll set that as joint and we're going to set that as capital gain tax yes, so that Snap can automatically calculate and deduct the taxes payable when we sell it. And we're going to do that at their age of 75. Once again, you have the option to click on the gear symbol in order to set a specific transaction date, or as a simple assumption, we assume that it takes place at the beginning of the year so that there's no additional appreciation in that year that it's being sold. So now we've set up all the capital assets for Rianne. We've set the 2 joint real assets and we can click on Olivia's name to go to her input page. We'll see the default non-registered that we can remove from the plan. And then we'll enter in Olivia's accounts. So she has a non-reg for $50,000. That's invested 100% as fixed income. She has a TFSA of $90,000 invested as 30% fixed income, 70% equity. She has a personal RSP of $120,000 invested as 40% fixed income, 60% equity. And then she has a group RSP through work for $80,000. That's invested as 50% fixed income and 50% equity. Again, across the top, we can go through the various account settings, make sure that we're comfortable. So they've made all their contributions and we'll just have room as of 2024. If we go to the RSP, we can update her room to $50,000 based off of her most recent notice of assessment. And then we can go to the employer matching tab. So for her group RRSP, we want to go to the employment income column and change it to link to the client's employment income. And then we're going to enter 5% for her contributions and an equal 5% matching from her employer. So these contributions will automatically show on our planning page, and that will automatically be factored into her taxable income and everything else. So that's everything for the assets page. I'll click next and go to debts. So I'll add a debt. We have the mortgage, balance of $120,000, interest rate of 5%, and monthly payments of $1,800. And we'll link that to the home. This just means that if at any point we sell the home in the plan, Snap will automatically repay any outstanding mortgage with the proceeds before using it for any other purposes. And then we have the rental mortgage. And we can set that as tax deductible so that Snap will automatically calculate the annual interest and use that for taxable deductions, and we'll link it to the rental property in the plan. I'll click next and we'll be able to finish up the final input page for this projection. We're going to start with Rianne's government benefits. By default, Snap starts CPP as of the client's retirement age or as soon as possible thereafter. And we assume the national average government benefit for CPP of 55% of the maximum. So because of Rianne's employment history and level of income, I'm going to assume closer to 85% of the maximum, so I can enter that here. You could also just enter in the dollar amount if the client knows that from a Service Canada statement, or if they're already receiving CPP. And then for old age security, we're going to assume 65 and 100% of the maximum. Clicking on Olivia's name in the top left, I'll go to her page and adjust the CPP start age. Instead of retirement, I'm going to assume that she'll wait until 65 and that she'll receive 80% of the maximum since she is retiring 2 years before she starts taking CPP. And then we have 100% of OAS for her as well. And that's all the inputs that we'll be doing for today's projection. You can see on the left that there are still pages available in the scenario setup flow. We could add insurance policies, conduct life needs analysis to see if more insurance might be required, add RESPs, corporations, and customize additional settings. But for our purposes, we're going to want to spend some time to review the planning pages and see those enhancements before moving on today. So I'll click planning pages, and we'll be able to see how all of this information has come together to create our projection for Rianne and Olivia. And before I go any further, I'm just going to pause for a moment, see if there's any questions that have come in from Lee and Anu.
Yeah, there's been lots of questions, Steve. We're working through them one at a time. We may not get to all of them. I'll keep reviewing them and see if there's any to bring up for everyone. But yeah, I would say just keep going at this point.
Perfect. All right. So we've landed on the planning pages with all of our plan data now input in the projection. And we're just going to make 2 final changes to the plan before we're ready to review it. So for contributions to investment accounts, we do that from the individual planning pages. So I'll go to Rianne's page first. I'll go to the tax-free savings account where he's currently maxing out his annual contribution. I'll click on the 0 amount. I'll enter in $20,000 and I'm going to copy that down until age 64. The reason I'm entering 20,000 is because SNAP has automatic guardrails in place that will prevent me from over contributing to a registered account. So when I click run scenario in the top right, SNAP is going to calculate the annual room each year, and it's only going to allow me to contribute up to that limit. So I'll click run scenario. And now I can see that SNAP has automatically changed my contributions to the expected annual maximum with the assumed indexing at the $500 increments. So that's a quick kind of cheat code for entering in maxed out contributions to a TFSA or RSP. And you can also do that for LIF and RIF accounts. If you want to take out the minimum value, you would just put a $0 withdrawal and SNAP will take out the minimum allowable. And then we'll also enter in $5,000 a year to the RRSP. And you'll see when I make the change on the planning page, the run scenario button turns red. This just means that my change hasn't yet been recalculated throughout the projection. When I click the red run scenario, it'll turn green and all of the numbers in the plan will be up to date. I'll go to Olivia and do the same for her TFSA. So I'll go to the tax-free savings account, click on the first year's contribution, enter 20,000, copy that down until the last year of work. And then when I click run scenario, SNAP will correct that to the annual maximum each year. So now we have 6,500 followed by the inflation adjusted amount each year. You can also see that the group RSP that we entered with the employee and employer contributions has been automatically entered on this page. So that's the one exception for ongoing contributions to a capital asset. Anything that's tied to an employee employment income, you would enter on the assets page and then it's going to be automatically calculated and displayed here. The final thing that we need to do is to fund the gift to the children that's occurring as of 2027 in the plan. So by default in SNAP projections, there are 2 periods to a plan. There is the pre-cash flow management period and the post-cash flow management period. So in this year, we switch from assuming that everything gets spent unless you've allocated a contribution elsewhere in the software to assuming that this exact target base expense gets spent each year and the software can automatically allocate money to and from accounts as needed. So because we have this expense prior to the cash flow management, we're just going to need to withdraw from each of their non-registered accounts in order to fund that spending need. So I'll go to the non-registered for the gift to children, and in 2027, I'm going to take out 75,000 from each of their individual portions. So now that we've withdrawn the 150,000 total, that's going to fully fund the gift to the children, and that means that our spending is back in line with the previous year and the year to follow. So that's only necessary because it's before we've set a target spending. Otherwise, Snap doesn't know how much spending we want for these years. You do have the option to start the cash flow management right from the beginning of the projection, but it's not our recommended approach because if you understate the client's spending need, then you may overinflate how much they're actually saving, because the surplus cash flow would be automatically allocated to their capital assets for the period that they're working. So by default, we recommend entering in the contributions manually, and then in retirement, setting a target spending and allowing Snap to automatically withdraw money as needed for you. So now that we've entered all of the plan data, we're ready to start reviewing the projection and looking at some of the recent changes to the planning pages. So one thing that you'll notice is all of our base and additional expense data is here available for us. So if we go down to retirement in 2032, that $96,000 a year spending goal has been input. Snap is automatically inflating that forward throughout the projection. And then we have the additional travel that was 15,000, that's been indexed for inflation. We have the car purchase of 35,000, and we can see that that's happening every 5 years for our desired period. This 96,000 is where we can change the spending if we want, or this is where we could have entered the value instead of putting it on that original scenario setup page. So you can always change the client's base spending need directly from the planning page. As we continue on over to the right, we'll see some of the additional enhancements to the Snap planning pages. The first thing is the ability to expand and collapse different sections of the page. So now with incomes, we can get a really quick summary of how much employment income and other income is available. Or if we expand that section, we can get more granular detail about where those incomes are coming from. If I hover my mouse over top of the column header for a column, so here I have employment income, and you may be able to see the small box to the right of my cursor is saying Rianne. So this employment column relates to Rianne. If I move my mouse over here, you can see this one relates to Olivia. So we can get all of the information that we need now available directly from the combined planning page. So previously you needed to go to the individual planning pages or into the client report to get some of this key information. And the recent enhancements to the planning pages has brought all of that right to the forefront directly from the combined planning page. If we collapse that once again, we can simplify the projection and then focus our discussions or analysis elsewhere on the page. If I click expand on things like benefits, I can see CPP, OAS, and OAS clawback. So again, I can dig into the relevant information and then collapse that to save room on the page. Some of the most critical information that's now been brought to the combined planning page is the contributions and withdrawals to capital assets. So now we can see that in the year that we're giving the gift to the children, we've appropriately withdrawn $150,000 to fund that. In the other years, we can see how much we're contributing to the tax-free savings accounts. We can see the RSP contributions for the group account and the personal contributions for Rianne. And then we can see a total value contributed or withdrawn each year of the plan. We can also see how much is being paid or taken from our existing debts. And then we can see the value of the properties and the future sale price of the property that we're selling. So lots more information now available. Again, you can expand and collapse as you need. And if you hover your mouse over top of any of the columns, so for instance, with this tax-free savings, if I hover my mouse, I can see that this one is for Rianne. In addition to all of those enhancements, we've also made the column headers a direct hyperlink to their relevant scenario setup page. So if I click on this capital assets title, I'll be taken directly to the capital assets section of the scenario setup. So I can make changes directly from there before returning to the planning pages. If you make any changes to the expanded and collapsed status of the columns, those preferences will be saved for your active session. So if you leave the plan and then come back, those same expanded states will be in place. And then once you return to the software in the future, it'll go back to the default. And the default settings are primarily to have the combined planning page collapsed to save room and the individual planning pages expanded so that you can see as much detail as possible. So we can see all of these sections are expanded so that you have as much information as necessary. Coming back to the combined page for a moment, we can go to the first year of retirement in order to see how the software is doing all of its calculations. So in the first year, we have 96,000 of real spending for our base needs. That's been indexed to 113,000 in that future year. We also have 17,000 of additional travel, 41,000 of a car purchase. As we continue to scroll over, we can also see that we're paying 24,000 towards the mortgage. And so Snap Projections has automatically withdrawn $124,000 from our capital assets in order to supplement our government benefits and pay for all of those ongoing expenses. So we can really get a sense of how the projection is progressing, where money is coming from, how much is remaining. So at this point, we can see we've got about $1 million left. We're withdrawing about 40,000 a year, so our drawdown rate is a little under 4% per year. If we go all the way to the bottom of the planning page, we can see that their goal is fully funded. There's no shortfalls in the net cash flow column. If we scroll to the right, we can see that they're left with about $1.2 million in the final year, plus their home. And if we click on the estate before tax figure, we can get a clean table that outlines where the money is being held and any tax on estate that's expected to be charged. We can also see what the projected estate is in today's dollars to get a reference point for our discussions with the clients. So that's quite a bit of additional information. I'm going to pause there for a moment, see if there have been any questions that have come in from the group.
Great. Okay, Steve, there's a couple things. Just looking at the time here. One question just about, let's see, the net rental income, just as a clarification that we're using net in terms of it's the gross income minus the expenses, not minus taxes.
Correct. Yes, so we're entering it as a taxable income. So we've set the taxable column to yes. So Snap is going to deduct the taxes. This is just net of or net expenses related to property taxes, insurance, maintenance, non-debt, so not interest expenses, because that's being tracked separately by the mortgage. The fact that we entered the rental mortgage and set that to tax deductible, that's automatically going to be taken care of for us. So all that we want to subtract in terms of the rental input is the non-debt and non-tax related expenses.
Terrific. Okay, and we do have a few questions about, like, just in general, the cash flow management and the order of contributions and withdrawals, and that's something that we typically go into quite a bit of detail in the webinars, but I think if we have time at the end, maybe we can go into it, but I'll let you continue with the plan.
Okay. Awesome. Yeah, so in terms of cash flow management and orders and things like that, I'd recommend, in case we don't have time to get to a full explanation in today's session, if you go to Help and then Help Center, our most recent webinar under the webinars section was almost entirely dedicated to that type of analysis. So if you go to the Help Your Clients Get the Most from Their Money, that's going to talk about how to change the cash flow management, what are the default settings, how would you compare alternate options. So I'd recommend checking that out, and we'll try to cover it a bit during today's session as well. So I only have a few more additions to the plan that I wanted to highlight. If I go to the top of this scenario, I can update the title now that we're done making any changes. So we'll just call this base projection with target 96K. So now we have our scenario one complete. We could go into the client report. We can customize what pages we want to include in the report. So depending on how complex the case is, how sophisticated your client is, and how much information they want, you can check or uncheck different sections. We have previous webinars about what pages we recommend including, and then you can go to any of the pages and customize those as well. So if we wanted to go to the cash inflows chart, for instance, right now it's a bit, the y-axis is a bit skewed by the sale of the property at age 75. So we could come up to the legend at the top here and uncheck the 2 types of income associated with that year. So that's going to create a much more clean chart for us. And then we could add a comment here to just outline that they're selling their property at age 75 and how much we expect that they'll receive after tax. Then once we're done making all of those changes, we would go to report preview, review the pages to see that everything makes sense, and then we can click on generate PDF in the top right. If we wanted to, we could run additional scenarios. So I'll click on the scenario menu, these 3 horizontal lines, and then I'll click copy scenario. And then we could update the title of this to be with corporate assets included. So if we wanted a second scenario where we also factor in a corporation, so I can click add corporation, call this corporation XYZ. Now we do have a dedicated webinar and a few videos outlining how to get the most from the corporate functionality in Snap. There were just 2 quick things that I wanted to highlight for today's session. The first is that we've recently added a new disposition method, so it gives you more control over how the tax on estate is going to be handled for your clients' corporations. And we added corporate insurance so that you can automatically include the cost base, cash surrender value, death benefit, and all of that information will be factored into the plan in order to automatically calculate and pay out CDA and everything else related to the insurance strategy. And this can help you to demonstrate any value in those types of strategies for your clients' needs. If we go to the planning page of the corporation, I just want to show that if you have distributions from a corporation, so if we're earning business income, for instance, of 100,000 down to age 64, and then we're paying that out as employment income or salary for Rianne, these distributions or any distributions coming from the corporation will show up on the combined planning page on the very right-hand side. So as I come to the combined planning page and go to the right, now we see a section for corporations, and this has to do with the distributions that I just entered. So you may be familiar or used to those showing up more under the income section. When we made the update to categorize things in line with the scenario setup to make it easier to find and edit plans, we also added the corporation's information towards the right-hand side of the page. So this is where you can find total distributions. And if you would like, you can also find information about the corporate value from the client's personal planning page. So if we scroll all the way to the right, you can see the, so I guess in this case, the corporate value is 0. So it doesn't show up with a dedicated column, which is another recent enhancement where if a column is 0 all the way down, in order to save space, we just remove that column from the projection in order to simplify the table. But that's everything that I wanted to cover in terms of dedicated functionality today, so I can open it right up to questions and see what else has come in during the session.
All right, thanks, Steve. I think one thing maybe we could clarify a little bit is that the pension contributions that we made towards the defined benefit pension plan and how we're using a negative income for that and how that affects the plan and so on.
Yeah, so let's start just by deleting that to begin with. So if we just have the client's employment income and their net rental income and their pension in the future, we can go to the individual planning page. And when we look at the client's, so I'll have to delete the corporation just to simplify things. So if we look at Rian in the first year of the projection, he has 100,000 of employment income and 10,000 of taxable net rental income. That's creating a taxable income of about 103,000 because he's also contributing 5,000 into the RRSP. So if we click on the taxable income details table, we can see he's got employment income, other taxable rental income, he's got some investment income from his non-reg portfolio, and then he has the registered withdrawal coming, the registered contribution, which is giving him a tax deduction, and then he has the interest deduction from his rental mortgage. So that is all resulting in 103,000 of taxable income, which shows as a marginal tax rate of 31% and an effective tax rate of 20%. But what we know from our conversations with Rian is that in order to generate this pension room or this future pension benefit, he's contributing about $6,500 a year into his works pension plan. And that contribution is a tax deductible expense for him. And so if we come to incomes and enter that in as a pension contribution of negative 6,500, so this is a negative value because it's reducing his taxable income and reducing his cash flow. So if we go pension contribution, negative 6,500, taxable yes, and run that until the same year as his employment income. Now when we come to the planning pages, we can see that his taxable income has been reduced by that 6,500 amount. And so his effective tax rate is lower. In this case, it hasn't actually impacted his marginal rate. He's still in the same bracket, but it's possible that doing this more granular tax information is going to give us a better picture about our clients' marginal tax rates, and that can impact things like recommendations around RSPs and TFSA contributions. This sort of adjustment isn't required. If we hadn't made this, all that would happen is the base expenses would be slightly higher, but it's not as though it's going to impact the future cash flows of the projection and the sustainability of the client's projection. It's just an optional step that we can take in order to more accurately model our client's case.
Thanks, Steve. Yeah, and that's where those tax deductible expenses can go. At some point in the future, we may have the ability under the expenses page to add those additional expenses as a tax deductible expense, but right now we just don't have that option, which is why we have to use the negative income still at this point.
Yeah.
Okay. Yeah, you showed such a lot of great information. One question was scrolling left to right, and if there's any tips on that.
Yeah, so if you're using the planning pages, you'll see at the bottom here that there's a bar that you would typically grab in order to move left to right. You can also get certain mouse products that have a scroll left to right. So you'll see my cursor's in the middle of the screen, but I'm able to go left to right just using my mouse. Or if you're on a Windows computer, you can hold, I believe it's Control. You can correct me if I'm wrong, Lee, but you can hold Control and then shift up and or scroll up and down.
Yeah,
and that's
exactly.
going to move you left and right instead. So
instead of shift,
okay,
not Control.
Shift.
Yeah.
Sorry. So instead of having to come down to the bar here at the bottom, which can sometimes be hidden by things like a Zoom meeting link or something, you can hold shift and then scroll up and down, and that's going to move you left to right, just in terms of navigating throughout the software.
Okay, and we just had a couple of follow-up questions again about those pension contributions. How does that relate to the pension adjustment? Like, it does not reduce your RSP contribution room by putting that pension contribution as a negative income, but what does affect the RSP contribution room is that pension adjustment, which Steve's showing right now.
Yeah. So this is one area where, if we look at the pension, like defined benefit pension plans are quite complex in their calculations and their administration. So this is something that our development team is tracking and gradually building out a fairly robust list of required feature enhancements. But when you have a defined benefit pension plan, this value is simply reducing our cash flow and our taxable income. And you'll notice that I have not set the RSP eligible category to yes, because I don't want this impacting the RSP calculation. I just want it impacting the cash flow and the taxes. And then in order to track the RSP information and the pension adjustment, I'm just going to the client's notice of assessment or their tax forms, and I'm getting the pension adjustment related to the pension defined benefit pension plan, and I'm putting that in here. And that's going to reduce the annual contribution room that's being calculated for them.
Right. And I think the main thing to note there is that this is all happening in the years before we started the automatic cash flow management. And so if you did not enter any pension adjustment or pension contributions, what you would just need to be aware of is what is the leftover money for the total base expenses. If you're trying to track that with your clients to say this is what you have left over to spend during the year, and also just trying to make sure you're not over contributing, that you're aware that they do have a reduction in what they can contribute due to that defined benefit pension.
Yeah.
So you can keep it simple. We're just showing today a little bit of extra detail that you can put in if you'd like.
And to further on that point, if I copy this scenario and I remove the pension adjustment, so I'm just going to go to incomes, and I'm going to remove this income row and go back to planning page. If I then, from the combined planning page, if I go all the way to the right and go to the estate before tax column, I can click on this teal blue box, which is going to bring up a comparison of the final year of the plan. So you'll see in scenario 2, where I had the pension adjustment input included, and in scenario 3 now, where I've excluded it, the final estate is the same value. So including it or excluding it doesn't actually impact the retirement period of the plan. It's just providing a bit more granularity and detail during the pre-retirement period so that we have a bit more accurate tax information. But these types of I guess, granular details, we did a whole webinar previously where we kind of made a bunch of adjustments that are all optional in the software, and it only impacted the final estate by about 5%. So that's one of the great things about Snap Plans is you can create a simple and straightforward plan in 15 minutes that's going to give you very good directional data. And then you can spend a few hours if you have the time and if it's warranted to more granularly model out what's happening, and it'll have fairly minor impacts on the overall projection and what your recommendations might be, but it's going to show your client that you fully understand their situation and that you've factored everything into the projection.
Thanks, Steve. I think one of those that we've heard a little bit recently in the support team has been starting the projections mid-year, because we're now at the middle of the year, and when we enter in asset values and debt balances and so on, is considered the beginning of the year values. So there are adjustments that we can make to start the projections next year if that's easier. We could also adjust the rate of return for the first year of the plan so that it doesn't grow as much between now and the end of the year. And those are, again, the granular details that you can adjust, but in the long term, it doesn't make much of a difference in your plan. That's the question. How much time do you want to spend on those types of things?
I guess one final thing came to mind. So a lot of users don't know that for the sustainable spending calculation, so if I go to recommendations up here, we have a sustainable spending tool that can calculate the maximum annual spending that the client can achieve in order to use up all of the capital assets by the end of the plan. So in this case, the client could increase their $96,000 a year goal up to $105,000 if they wanted to deplete everything by the end of the plan. By default, that starts in the first year of the cash flow management at 65 and 63, but these values are actually editable. So you can start that calculation in any year. If you want to assume they're going to spend 96,000 for the first decade, and then you would start your calculation at age 75, you can change these values, and then the spending would only be adjusted for that latter period of the plan. And that's a common theme throughout Snap. Anytime that you see a blue value, it means that you can interact with it in some way. So same with this adjustments in the top right. and various values throughout things like the stress testing module and elsewhere in the plan. So if you see a blue value, you can interact with that in order to customize it. But that is us at time. Really appreciate everyone joining. Once again, for the CE credits for those who attended, we will be sending out an email within the next 2 hours with the recording for today's session and with a quick 3-question survey so that we can gather your personal information and send you the certificate. If you have any questions, feel free to send us an email, give us a call. If we didn't get back to you during today's session, we will respond by email within the next few days. Again, appreciate you joining us and hope you have a great rest of your day.
Thanks, everybody.